Welcome to this explainer. Today, we're dismantling one of the absolute most persistent myths in modern finance. We're going to completely demystify the actual mechanical differences between Benjamin Graham, the legendary father of value investing, and his most famous student, Warren Buffett. We're moving way past the standard folklore here to look at the real structural engineering behind how these two world-class capital allocators actually built their wealth. Okay, let's dive into this.
Right, so if you spend any time reading about finance, you have probably run into this lazy bumper sticker myth. It goes something like this: Graham liked cheap garbage, but Buffett grew up and bought great businesses. It paints this ridiculous picture of two high priests fighting some sort of religious war over value investing, where Buffett somehow achieved this magical enlightenment and realized his mentor was just plain wrong. But honestly, that completely and fundamentally misunderstands what actually happened.
That cliché is entirely useless, mostly because it masks a much more fascinating reality. Look, Benjamin Graham was not stupid, and Warren Buffett didn't just casually abandon his mentor's teachings. Instead, I want you to think of these two men as brilliant software engineers. They were literally building totally distinct corporate operating systems that were perfectly tailored to their respective economic eras. And even more importantly, they were tailored to the massive differences in the scale of capital they were managing at the time.
Section 1. Graham's liquidation engine.
To really understand this evolution, we have to travel back to the post-depression era and look at Graham's highly mechanical approach. Right at the beating heart of his system was something called net current asset value, or NCAV. He was out there hunting for heavily discounted cigar butts. And just look at how absolutely ruthless this math is. He took current assets, subtracted all liabilities, subtracted preferred stock, and gave exactly zero value to property, factories, equipment, or any brand intangibles. Zero. Graham honestly didn't care if the underlying business was a dying textile mill. For him, the safety wasn't in the business quality at all. The safety was 100% embedded in that mathematically cheap entry price.
So how did he actually execute this? Well, Graham's system was essentially a four-step, short-term liquidation arbitrage trade. Step 1, you buy a statistical basket of these deeply discounted assets. Step 2, you just wait for the market to wake up and realize the mispricing, or you wait for a liquidation event to force the issue. Step 3, once the price recovers to the asset value, you sell ruthlessly. And Step 4, repeat. Oh, and you absolutely had to buy a super wide basket of these things because frankly, some of these terrible businesses were going straight to bankruptcy. Extreme diversification was literally required just to survive.
Section 2. Buffett's operating system update.
But what happens when you just become too successful? There was a very real critical pivot point where Graham's deep value asset hunting models simply could not scale anymore. When Buffett's capital base grew into the tens of millions, he couldn't exactly squeeze all that money into tiny, dying manufacturing plants without completely ruining the trade. He was literally forced to rewrite the investment code. And this brilliantly illustrates the definitive break between their two systems. Graham anchored all his safety to the balance sheet, looking at exactly what was there today, while Buffett learned to anchor to the income statement, focusing entirely on tomorrow's earning engines.
Which brings us right to Buffett's defining concept, the economic moat. Heavily influenced by his partner Charlie Munger, Buffett shifted gears to buying amazing businesses like See's Candies. Now, under Graham's old formula, paying a premium just for a candy brand's intangible goodwill? No way. That was absolute heresy. But Buffett realized that a durable competitive advantage, meaning pricing power that lets a business generate huge returns without constantly needing new physical capital pumped into it, was actually a much safer, long-duration margin of safety. He essentially transformed a strategy from short-term corporate dentistry right into a permanent compounding engine.
When you really break the whole thing down into a matrix, it's fascinating to see exactly what Buffett kept and what he entirely threw out. He kept Graham's psychological armor, for sure, that strict demand for a margin of safety and a total emotional detachment from the market's manic mood swings. But look at the execution side. He swapped a short-term reversion trade for a permanent hold. He swapped a wide statistical basket of mediocre stocks for highly concentrated conviction in just a few exceptional companies. And crucially, he evolved from a standard, fragile investment partnership into a permanent corporate capital structure.
Section 3. Warren Buffett's core rules.
So how does this updated operating system actually translate into actionable guidelines for navigating the modern stock market? Well, it all starts with rule number 1, which is famously simple: never lose money. Now, obviously, Buffett doesn't mean a stock price can never dip on a random Tuesday.
Come on. What this rule really means is avoiding the permanent loss of capital. It is all about protecting yourself from those disastrous, unrecoverable decisions caused by poor judgment or investing outside what you actually understand or using excessive leverage that eventually forces you to sell at the exact bottom.
So, the crucial point is how all 7 of these rules work together as one cohesive, giant defense mechanism. You demand a margin of safety and you focus strictly on intrinsic value. Then, you combine that with buying quality companies, staying ruthlessly inside your circle of competence, seizing big opportunities when they happen, and totally ignoring all that short-term market noise. Finally, you have to be contrarian. This entire architecture requires extreme, almost painful patience to just wait for the perfect pitch, and the emotional detachment to be greedy only when the rest of the market is absolutely panicking.
Section 4. The danger of cosplay.
All right, here's where we have to shift away from billionaire theory and look at a real retail investor's reality check. Can you, sitting at home with a laptop, actually just copy Warren Buffett? Honestly, the hard truth is, if you try to execute Buffett's heavy portfolio concentration, putting half your net worth into just 3 or 4 stocks, inside a standard retail brokerage account, you are literally baking a recipe for disaster.
Because it all comes down to capital structure. Buffett operates with what we call permanent capital. Berkshire Hathaway has this massive insurance float that simply cannot be called in by panicked investors during a market crash. It is a literal insulated fortress. Most retail investors, on the other hand, are operating with fragile capital. You have personal liquidity needs, you might be using standard broker margin, which can trigger a brutal margin call, and you probably suffer from the psychological anxiety of underperforming the S&P 500. Without that institutional flow to absorb massive market beatdowns, retail investors attempting Buffett cosplay face catastrophic forced liquidations at the exact worst possible moment.
Which leads us with this final, vital reality check. The ultimate lesson from studying Graham and Buffett isn't about picking a side in some fake finance debate. It is about structural honesty. Are you actually matching your investment strategy to the real duration, stability, and limits of your own capital? Or are you just relying on finance folklore and playing dress-up? You need to think deeply about what your personal capital can actually withstand, build your own operating system around that reality, and stop copying a billionaire's output if you don't have their input.